Hi everyone, this is Tung-Yi Chuang from the online section of CSC 559 course. Today I'm going to talk about Chapter 3, World Markets. And specifically, of course, we're talking about financial markets. The financial markets are extremely huge and diverse, and many different kinds of financial assets and products are created and utilized. What makes financial markets so important is that they are the cornerstones of capitalistic economies. They help facilitate capital formation and liquidity for entrepreneurs and businesses. Financial markets create liquidity by making it easy for buyers and sellers to trade their financial holdings. Without the infrastructure of a market, sellers would have to find individual buyers themselves or use some less efficient methods, such as classified advertisements. In addition, the centralized location provides transparency for price availability and better subjects the securities to market forces of supply and demand. This, in turn, assures buyers and sellers of a fair price than they might otherwise receive in a single private transaction. And this is why we should have a pretty decent understanding of this topic. This is the outline of my presentation. I'll first talk about various kinds of financial assets. Then we will discuss how the market and the trading field work and show the differences between the past and the present. Also, we will talk about some new systems or platforms that have started to spread and change the financial world. We will then talk about the trends that most markets in the world share in common. Last but not least, we will compare the asset classes in terms of their market value and see which asset class has the greatest impact. The world's financial markets are so huge. In general, we can divide them into four main groups: capital markets, foreign exchange markets, money markets, and derivative markets. Each market has its own identity and feature. For example, capital markets channel savings and investments between suppliers of capital and users of capital. Capital markets are important for the functioning of an economy because capital is a critical component for generating economic output. The foreign exchange market is known as the forex market, currency trading market, or just FX. It is a market where participants buy, sell, and exchange currencies. It facilitates the trade of trillions of dollars every day. There is no central location. Instead, money is traded through a network of international dealers and brokers. The money market is where securities with high liquidity and very short-term maturities are traded. It is used by participants as a means for borrowing and lending in the short term, with maturities that usually range from overnight to just under a year. The derivatives market, as the name suggests, is the financial market for derivatives such as futures, forwards, options, swaps, and credit derivatives, etc. Now we will discuss some of the major asset classes. Equity. Equity has several meanings that vary by their context, but in general, each refers to ownership. Equity also applies to the securities in the margin account, minus what an investor borrows from a broker. But in general, equity is the value of a business or property after its debt and liabilities are paid. Think of equity as ownership in any asset after all debt stemming from that asset are paid. A car or a house with no outstanding debt is the owner's equity because he or she can simply sell the item and receive cash. Stocks are considered equity as well because they represent ownership in a firm. Determining the fair value for equities is actually a pretty complex process, and many different theories and methods can be used to evaluate equity. Fixed income. Fixed income assets, or fixed income security, is an investment that provides a return in the form of fixed periodic payments, and the principal is returned at maturity time. The payment can be in the form of a coupon payment, a dividend on the stock, or an interest payment. The rate of return is fixed at the time the security is purchased, so the investor knows exactly how much income he or she will earn from this security. Because of this certainty, fixed income securities usually have a relatively lower rate of return. And this means that very often it is especially popular for risk-averse investors. Examples of fixed income securities are treasury bonds, certificates of deposit, and preferred stock with a stated dividend rate. For example, an investor might own a 30-year treasury bond with a face amount of $1,000 and a coupon rate of 4%. The investor can count on receiving $40 annually for 30 years. And at that time, he or she will receive the final interest payment plus his $1,000 principal. The foreign exchange market is known as the forex market, currency trading market, or just FX. It's a market where participants buy, sell, and exchange currencies. It is the largest and most liquid market, with average traded values that can be trillions of dollars per day. In the forex market, as one major forex market closes, another one in the world opens. Unlike stocks, the forex market operates 24 hours a day, except on weekends. Traders find this as one of the most compelling reasons to choose forex because it provides convenient opportunities for those who are in school or work during regular work days and hours. There's no central location. Instead, money is traded through a network of international dealers and brokers. Businesses use the forex market when they are buying products from other countries. For example, suppose a US company wants to buy a car from the UK. The car is transferred from the UK to the US, and the US company has to convert US dollars to pounds to pay for the good. The US company uses the forex market to convert dollars to pounds at the current exchange rate. Speculators will attempt to buy currencies that they think will increase in value and sell currencies they think will decrease in value. There are many factors that contribute to a change in exchange rate, including monetary policy, political stability, interest rates, inflation, or imports and exports, to name a few. Money markets, as we mentioned before, are important short-term financing markets. They are safe, liquid investments that are well suited to small investors. They typically invest in steady funds, such as treasury bills and commercial paper. Commercial paper is a short-term debt security issued by financial companies or large corporations. The corporation promises the buyer a return or profit for making the loan, and the return is stated as the interest rate, or a percentage of the loan, such as 5%. Companies sell commercial paper when they need a short-term loan to pay for such things as accounts payable or inventories. The securities are often sold at a discount and redeemed at full value. Most commercial paper matures in 1 to 6 months. Debt that matures in less than 270 days does not require registration with the SEC. By avoiding SEC registration, it is cheaper, which means it is a major benefit for companies. Commercial paper is unsecured, meaning that buyers have no claim on a company's asset if the company fails to pay up at maturity. So, only firms with good credit can successfully sell commercial paper. Traditionally, commercial paper is sold in large denominations of $100,000 or more to large institutions or rich people. But it's increasingly becoming more available to small investors. Let's say you want to go traveling somewhere like 12 months later and you want to save some money. Because your time horizon is short, just 1 year, you can choose to invest your savings in a money market fund. Money market funds are short term, so funds are invested for a limited period of time. Treasury funds, or commercial paper, last an average about 1 year or less. If you need your money from one of these accounts before the investment time is ended, many money market funds offer the choice of selling the fund, usually for a smaller profit than if the money had stayed in the account until the term ended. Opening a money market funds account is as simple as opening a savings account, only with a few differences. The account usually requires a minimum balance to open, and you must leave your money in the account for a specific period of time. Although money market funds do not yield a huge return, they generally offer higher interest rates than most savings accounts, and they are more convenient for short-term investors. Repurchase agreement, or repo, is a short-term borrowing for dealers in government securities. For the party selling the security and agreeing to repurchase in the future, it is a repo. For the other side of the agreement, it is called a reverse repurchase agreement. Repurchase agreements are generally considered safe investments because the security in question functions as collateral, which is why most agreements involve U.S. Treasury bonds. The Federal Reserve enters into repurchase agreements to regulate the money supply and bank reserves, and individuals normally use these agreements to finance the purchase of debt securities or other investments. Derivatives is a product that derives its value from underlying asset classes, either equities or fixed income products. Examples of derivatives are forwards, futures, options, swaps, and credit derivatives. Derivatives can either be traded over the counter or on an exchange. In general, over-the-counter derivatives are riskier because they are unregulated and non-standardized. A forward contract is an agreement to buy or sell a fixed quantity of a given asset at a certain price at a specific date in the future. And the main difference between a forward contract and a futures contract is that futures are traded on an exchange, which means they are standardized. Options are another common form of derivative. An option is similar to a futures contract, but the difference is that with an option, the buyer or seller is not obligated to make the transaction if he or she decides not to, which makes the name option. Just like futures, options can be used to hedge the seller's stock against a price drop. A swap is when two parties exchange financial instruments such as interest rates, cash flow, stocks, or even bonds. The most common financial swap is an interest rate swap. Swaps do not trade on exchanges, and retail investors do not generally engage in swaps. Instead, swaps are over-the-counter contracts between businesses or financial institutions. A credit derivative is yet another form of derivatives. It's an instrument that allows you to separate the credit or default risk from an asset or pool of debt instruments and trade them to another party. We're just separating the credit or default risk. None of the other features of the bond are part of the credit derivative. These can then be bought and sold between private parties or through the open market. Now, why would you want to do something like this? Well, for hedging purposes, if you're managing a portfolio that involves credit risk, you might want to actively manage the credit exposure in your positions, and you can increase or decrease the credit risk by using credit derivatives. You can also speculate on future credit events using credit derivatives. If you have a strong view on the movements of the overall markets, it's possible that you can profit from that view using credit derivatives. There are also a few types of financial assets that do not fit in the main categories that we just listed. For example, depository receipts, DR, and ETF, exchange traded funds. A depository receipt represents the shares that are issued by a foreign country. This means that investors can hold actual shares of other countries. One of the most common types of DR is ADR, which are traded on major US exchanges, and GDR, which can be traded in more than one country. ETF, or exchange traded funds, is a marketable security that tracks an index, a commodity, bond, or a basket of assets like an index fund. ETF trades like stock on an exchange. It is attractive and interesting to investors because one single ETF can represent the entire segment of the market. Another important aspect about ETF is that, like I said, they track an index. An index, such as S&P 500, clearly defines what constitutes the index. So it's different from a mutual fund in that you don't have a manager that actually selecting what's in the ETF. It's all done according to what's in that underlying index. The advantage of exchange-traded funds is that it's cost-effective. One share of an exchange-traded fund can represent an entire category. So, if investors are looking to build a globally diversified portfolio, they can actually have just very few investments in there. So, it becomes easier for investors to manage, to look at, and even to understand. Now, we're going to talk about the structure of the market. Initially, most markets begin with quote-driven trading, which means that asset prices are determined by the market makers, such as the dealers. This kind of trade seems to be not transparent because an investor cannot determine the price themselves. Gradually, as time goes by, the number of investors increased and more dealers came in. And this allows investors to check and compare the prices presented by many other dealers before actually make a trade. Although trading is still bilateral and quote-driven at this stage, at least there are more different prices to compare. Eventually, in the end, the market becomes so large that the whole market is like this right here. Inter-dealer networks worked as an exchange, and the communications between dealers and clients were handled by brokers. For inter-dealer markets, basically, we can break it down into two categories: exchange-based trading and over-the-counter trading. Exchanges are probably the best known places for trading. It's generally adopted for more standardized assets, such as equities, futures, and options. Some examples for exchanges around the world are the New York Stock Exchange, the Chicago Board of Trade, London Stock Exchange, Tokyo Stock Exchange, etc. For OTC markets, it is less centralized and without a certain location. Over time, electronic trading platform has become a very popular tool in trading. Traditionally, brokers act as the middleman between dealers and clients. Nowadays, the so-called dealer-to-client markets, or D2C, are presented by either phone-based trading or electronic platforms. Alternative trading venues have become pretty important over the last few years. For example, the ECN and the dark pool. I will explain a little bit later about these two. Electronic communication networks are probably the best known off-exchange trading venues, or in other words, trading places. It electronically connects buyers and sellers so that they can directly trade stocks, currencies, and other financial instruments with other people. The main benefit of an ECN is that it eliminates the need for a third party, such as an investment bank. The rise of ECN has helped investors participate in after-hours and currency trading, and ECN has made it easy for people living in different hemispheres to trade with one another. ECNs charge a fee for each transaction. They must be registered with the SEC as broker-dealers. Transactions are automatic and immediate. Instanet was the first ECN, debuting in 1969 for use by all small brokerages and financial institutions. Other examples include the NASDAQ, SelectNet, and Bloomberg Tradebook. Instead of existing as a physical location, these ECNs are networks that accommodate trading outside of a traditional stock exchange. Some of the disadvantages including technology problems. For example, a serious system error might slow down or even stop the service. Another example would be the dark pool. Dark pools are private exchanges for trading large number of securities that are not accessible to the public. They facilitate block trading for institutional investors trying to avoid impacting the market with their large orders. Although it has always been criticized of their lack of transparency, dark pools still serve a purpose. For example, if dark pools are not available, and a large institutional investor wants to sell 1 million shares of a particular stock, the impact on the price will be huge. Investors will probably see as a sign to sell, and the price could fall. A dark pool lets the investor sell the block, and the lack of transparency works in his or her favor because the price would be better than if the shares were sold on an exchange. Some advantages for dark pools include reduced market impact and lower transaction costs. But dark pools are still in controversy because the exchange prices may not reflect the real market. For example, If a mutual fund owns 20% of a company's stock and sells it off in the dark pool, if the unaware investors later buy the stock, they will pay too much for it because the stock could then collapse when the big sale goes public. Next, we will talk about the global market trends. It is no doubt that there are differences among the world's financial markets. However, there are still some similarities, especially some specific categories are improving among most markets around the world. Electronic trading, transparency, and accessibility. Electronic trading is widely spread, in particular for standardized assets. It has completely changed the way people trade, since order placement and execution times are now measured in fractions of a second. Specifically, three evident changes by implementing electronic trading are increased speed of trading, massive growth in trading volume, and long-term decrease in order sizes. In the past, a delay of 300 milliseconds used to be perfectly reasonable, but nowadays, targeting latencies in microseconds. For transparency, we can divide it into post-trade and pre-trade transparency. Post-trade transparency is improving in both exchange-based and OTC markets. On the other hand, pre-trade transparency causes more issues in OTC markets because only the dealer's best bid and offer are available. Accessibility. Traditionally, the marketplaces are divided into two parties, the dealers and the clients, just like we mentioned before. However, electronic trading has blurred the difference between dealers and clients. Once an electronic platform is created, there is a lot less difference between the buy side and the sell side. The segmentation between dealers and clients is becoming not that obvious because of ECNs and ATS. When talking about the market trend, it's essential to understand the concept of centralization and fragmentation. There is a natural tendency for markets to centralize. But in recent years, many new market entrants, such as ECN and dark pool, are coming to the markets, and they are essentially fragmenting the whole market because they offer significant innovation and cost incentive in order to attract liquidity away from the centralized system. And this kind of competition often leads to the fragmentation of the market. However, since the world is super competitive, the average cost of trading becomes so low that it is crucial for the existence of economies of scale. There is a strong force of consolidation. So they start to merge by acquiring other venues with each other. So centralization starts to occur again. And this continuing cycle keeps happening. Our textbook used the phrase wax and wane, which means that the level of centralization keeps jumping up and down, just like this plot shows. And by the way, there's no guarantee that this cycle is a steady equilibrium. Nobody knows what's going to happen in the future. Next, we are going to compare different kinds of asset classes in the world in terms of their overall size. This is the exact same graph that's in the textbook, page 75. It is trying to show us two things. First, we can see that the market values for these assets have all increased during the 5-year span from 2002 to 2006, especially for equity, with a 130 growth rate. If we make some simple calculations just based on this graph, we can get the percentages each asset class represents in each year. We can clearly see from this graph that in percentage terms, there is actually not much change from this 5-year span. And there's a fact that commercial bank assets and fixed income securities are always the top two in market values proportions. This is an interesting graph because it shows that electronic trading has become a very important factor in the trading industry. And it shows that it's growing at a very fast rate, especially for options. This is something we definitely have to pay attention to because it is possible that this trend will continue to grow and there's no sign of slowing down. The massive growth for options and futures is probably due to reuse of existing technology and a faster learning curve, benefiting from past experience. Overall, the equities market is still ahead of other markets in terms of levels of electronic trading and algorithm trading. Here's a quick summary. We are living in a fast-paced and ever-changing world. We must catch up with the global markets. And in order to do that, learning new trading venues, new trading methods, new trading strategies, and understand the essence of electronic trading is important because with these new inventions, we can do so many things that we couldn't accomplish before. Electronic trading offers the potential to make markets more transparent and more cost effective. It is still too early to say how the various markets may develop, but a lot of market participants expect a transition in certain markets to a fairly centralized and open network, allowing all market participants to transact directly with each other. Electronic trading is changing the world. Embrace it and be prepared. Thank you.